What are Bitcoins? Bitcoins are the first decentralized digital currency which takes place on a network of peer-to-peer transactions using cryptography. The transactions are verified through a public ledger called the blockchain. Bitcoins are created in a process called mining and can be exchanged for other currencies. Bitcoin was created in January of 2009 by Satoshi Nakamoto. Implemented Bitcoin open source software and mined the first block on the chain called the Genesis block, which was valued at 50 coins. Programmer Hal Finney mined the first block valued at 10 coins in the first ever transaction. Lee Dai, creator of Bitcoin predecessor B-Money, and Nick Szabo, creator of another predecessor BitGold, were some of the first supporters of Bitcoin. Pre-2013, the value of Bitcoin was very low and very negotiable. An early buyer of Bitcoin once traded 10,000 Bitcoins for 2 Papa John's pizzas. Between November and December of 2013, the value of Bitcoin jumped to just short of $1,000. Late November, the price crashed after the People's Bank of China issued comments on the insecurity of Bitcoin that scared people away from it. They said Bitcoin was not real currency and it was too volatile for stock portfolios. In February 2014, there was another crash in price due once again to comments from the People's Bank of China that drove the value down to around 300. In January 2016, the value slowly rose above 600. Since then, the value has steadily continued to rise all the way into 2017. In June 2017, the value rose around $2,800. In the fall of 2017, it rose up again to the $5,000 mark. In late November to early December, the value of Bitcoin has rapidly risen and fallen, all within the span of days. Companies are starting to realize the danger of accepting the fiat currency, and some, like Steam, for example, have dropped it as a payment option. As of current, the value of Bitcoin is just shy of the $17,000 mark. How Bitcoin works. Bitcoins are created through a process called mining. Bitcoins are mined by users setting up hardware and software to solve algorithms that confirms waiting transactions and including them in the blockchain. Anybody can buy the equipment for a small investment of a few $100s to do so. It is much more efficient to join a mining pool with other people than to try and do it yourself. Your chances of creating a block that houses the coins is a lot higher due to more computing power solving these advanced algorithms. After these digital coins are created in the blocks, you can then proceed to purchase them. You can use sites online to set up a Bitcoin wallet. The coins do not exist physically, but instead as a code that you can either store yourself on your computer or as a physical note if you're concerned about security. Bitcoins are transferred between people's Bitcoin wallets, which then are in turn put into the blockchain. Wallets keep a private key to sign the transactions for proof of ownership. This signature also prevents a transaction from being altered once it is issued. These transactions are confirmed through a process called mining. Mining confirms transactions by sending them into the blockchain. When enough computing power is devoted to the block, a new Bitcoin is created in each new block. There are 5 steps in this process. Number 1. Verify it is a valid transaction. 2. Bundle the transaction in a block. 3. Select the header of the most recent block and insert the bundle in as a hash. Number 4. Solve the work of proof problem. Step 1. Propose new block. Then you combine the header of the most recent block with the hash created, which creates a hash number. Next, it compares the hash number to the target value. The target value is the value that determines the mining difficulty. The higher the difficulty, the lower the target. The target value is determined by how many miners there are, the block creation rate, and mining time. If the number is greater than the target, the problem is not solved, and you increase the target value using that nonce formula and try again. If it is less, the problem is solved and it moves on to step 5. When the solution to the worker-proof problem is found, a new block is added to the blockchain and sent to the blockchain network. Pros and cons of Bitcoin. The pros. It is a free market. It is secure and private, and you remain anonymous till the time of the transaction. The value is not tied to any country. It has potential for high profits. The cons. Nobody oversees the transactions. It is very volatile currency. There is a lack of regulation, and there is potential for high losses. In order to start buying Bitcoins, you first need to set up a Bitcoin wallet. After you have done this, you can use a Bitcoin exchange to buy Bitcoins online. If you want to shop for Bitcoin more locally, you can search for local sellers. Just make sure they have good reviews and scores. Bitcoin ATMs are another option to buy that allow you to deposit and withdraw money to buy and sell Bitcoins right there.